In this video, I'll be discussing plant assets and the process of depreciation. In calculating depreciation, there are three factors that we have to know: cost, which we discussed extensively in the previous video, estimated salvage value, which is also known as the residual value, and the estimated useful life, which is also known as the service life. When we calculate depreciation, GAAP does not require us to calculate it in a certain way. It just says that we should charge the cost of a long-term asset to expense in a rational and systematic manner. So three ways that companies do this are the straight line method, the units of production method, and the declining balance method. So for our first example, we'll look at straight line. On January 1st, 2022, Hartley Company purchased a new manufacturing equipment for $1.6 million. The machine is estimated to have a 5-year life with $100,000 salvage value. So let's take a look at a view of these numbers. The $1.6 million is the cost of the asset, and we know that that includes all costs incurred to get it ready for its intended use. The 5-year life is the service life or the useful life. That is the period of time that we're expecting to use the asset, and the $100,000 residual value or salvage value is the amount that we expect to get back when we sell the asset at the end of its useful life. In this problem, the useful life is expressed two different ways. One in years, 5 years, which we will use for straight line depreciation and declining balance depreciation. For the units of production method, we need to know how many units Hartley expects to produce using the machine, and that is the 500,000 units. So for straight line depreciation, we're going to take the cost and subtract out the salvage value. 1.6 million minus 100,000 is 1.5 million, and we refer to that number as depreciable cost, and it's the total amount that we want to charge to depreciation over the life of the asset. We divide that by 5 years, the useful life, and we get $300,000 as our annual depreciation amount. So for each full year that we use the asset, we want to charge $300,000 to depreciation expense. Under units of production, we do a similar calculation, except that instead of using the useful life in years, we use the useful life in units. So we take the depreciable cost of 1.5 million divided by the 500,000 units, and we get a depreciation per unit charge of $3 per unit. In order to calculate 2022 depreciation, we need to know how many units the equipment produced in that period. 220,000 units were produced in 2022, so our depreciation expense is 220,000 times $3 per unit, or $660,000. For the double declining balance method, the first step is to calculate the straight line rate. If we are depreciating the asset over 5 years, we are depreciating 1/5 of the cost each year, or 20% per year. We double that rate, 20% times 2, to get 40% for double declining balance. And then we apply that rate to the asset's beginning of the period book value. Right? Recall that book value is cost minus accumulated depreciation. So for the first year, the book value of the asset is the cost of 1.6 million because we have not charged any depreciation expense yet. So for year 1, 40% of 1.6 million is $640,000. We're going to make a journal entry debiting depreciation expense and crediting accumulated depreciation for $640,000. The book value for year 2 is going to be the cost of 1.6 million minus the accumulated depreciation of 640,000, or 960,000. So for year 2, we're going to apply the 40% rate to the 960,000 and get 384,000. The accumulated depreciation balance then is the 640,000 plus the $384,000, or $1,024,000. For a partial year's depreciation, we need to prorate the depreciation for the number of months the asset was used during the period. So if on July 1, 2022, Appalachian Ski Mountain purchased new snow blowing equipment for $500,000, the machine has an estimated 10-year life and a $20,000 salvage value. So what amount of depreciation are we going to charge in 2022 if instead of buying the asset on January 1, we bought it on July 1? So we're going to calculate our depreciation by saying $500,000 minus our $20,000 salvage value. So we're charging $480,000 to depreciation expense over the life of the asset. So if we take 480 divided by 10, we get 48,000, and then if we are going to only depreciate it for 6 months in 2022, we're going to take 6 over 12, or 1/2 of that number, and charge $24,000 to depreciation expense. Depreciation expense has to be revised if there is a change in the asset's cost, its estimated salvage value, or its estimated useful life. So the procedure for revising depreciation expense is first to calculate the book value at the time of the change, and then subtract from that the revised salvage value and divide by the remaining useful life. So if on January 1 of 2022, Elton Inc. purchased equipment for $55,000, the machine is estimated to have a 5-year life with a $5,000 salvage value. Elton uses straight-line depreciation. At January 1, 2024, so they've used the asset for 22 and 23 at that point, they revised the estimated useful life to a total of 8 years and the salvage value to $3,000. All right, so we can first compute the original depreciation expense by saying cost of $55,000 minus our salvage value of $5,000 and dividing it by 5 years. So $55,000 minus $5,000 is $50,000, divided by 5 years is $10,000. Our accumulated depreciation is then going to be $20,000, and our book value at the time of the change is going to be 55 minus 25,000, or $35,000. So our revised depreciation expense is going to be the 35,000 minus the 3,000, and the remaining useful life is 8 divided by 2, 8 minus 2, or 6. So to get the revised depreciation expense for the remaining years of the asset's life, we're going to take the 32,000 and divide it by 6. And that is going to give us the amount of annual depreciation that we want to charge in 2024 and going forward. Once an asset is purchased, expenditures are going to be made to keep it in good working condition. And we refer to these as ordinary repairs. They include routine maintenance and any expenditures made to keep the asset in good operating condition. These are referred to as revenue expenditures because they are charged to an expense account, either repairs expense or repairs and maintenance expense. Other expenditures might be made to improve the asset's efficiency or its productivity or extend its useful life. Betterments are expenditures made to improve an asset's efficiency or productivity. Extraordinary repairs extend an asset's useful life. These types of expenditures are called capital expenditures because they are charged to the asset account. And once those costs are charged to the asset account, we're going to need to revise depreciation expense.